In the high-stakes arena of global finance, where digital currencies increasingly intersect with traditional economic forces, Bitcoin stands resolute near the $64,000 mark. Its ability to maintain this level amid recent turbulence raising profound questions about the trajectory of the entire cryptocurrency ecosystem and whether the current consolidation represents the foundation for a powerful upward surge or the deceptive calm preceding a sharper reversal. Welcome to Crypto Hub, the channel dedicated to delivering clear, factual, and thoroughly researched updates on cryptocurrency developments for our viewers seeking reliable insights in this complex field. Today we examine Bitcoin's steadfast position around $64,000, a price point that has served as both support and resistance in recent trading sessions, and we dissect the array of bullish and bearish elements at play to determine if a massive breakout toward higher valuations appears imminent or if the market is bracing for another significant correction that could test lower supports and shake investor confidence across the board. As trading data from major platforms reveals, Bitcoin has been oscillating in a relatively narrow band close to this $64,000 level over the past several days and weeks, with prices dipping toward the low 60,000 range at times before finding buyers willing to step in and defend the zone. This comes on the heels of a more pronounced decline from earlier peaks in the cycle, including levels approaching or exceeding $77,000 in late May of this year according to market trackers, representing a drawdown that, while substantial in percentage terms, has been characterized by some research firms as one of the mildest in Bitcoin's storied history when compared to prior post-halving corrections. The cryptocurrency's resilience at these levels is noteworthy, particularly because it follows a period of strong institutional interest that propelled prices higher after the 2024 halving event. Yet recent weeks have seen a shift with spot Bitcoin exchange-traded funds experiencing persistent net outflows amounting to billions of dollars over the trailing 30-day period, a development that has introduced caution among market participants even as other segments of the market show signs of accumulation. Delving deeper into the institutional landscape, while the exchange-traded product outflows signal some profit-taking or reallocation by larger players, on-chain analytics paint a more nuanced picture, with large holders or whales having reversed earlier selling patterns and now absorbing significant quantities of Bitcoin, reportedly taking control of the highest supply levels seen since March of this year and adding over 125,000 BTC in the first half of June alone. This divergence between traditional financial product flows and blockchain-based accumulation by sophisticated entities underscores the complexity of the current environment, where different cohorts of investors appear to be positioning themselves in contrasting ways, potentially setting the stage for increased volatility as these forces interact in the order books of major exchanges. Corporate treasury strategies continue to play a meaningful role as well, with companies maintaining or expanding their Bitcoin holdings despite the price action, providing a steady bid that helps underpin the market at these critical junctures and reinforces the narrative of Bitcoin as a long-term store of value for forward-thinking organizations navigating uncertain fiat currency landscapes. The mechanics of spot exchange, traded funds mean that when redemptions occur, the underlying Bitcoin is often sold on the open market or through authorized participants, which can exert direct downward pressure on spot prices, whereas corporate buying tends to remove coins from circulation for extended periods, creating a supply shock effect that supports prices over longer horizons even if short-term flows turn negative. From a macroeconomic perspective, the recent Federal Open Market Committee communications have added layers of intrigue, with certain officials adopting notably hawkish stances that have elevated the probabilities of interest rate increases later in 2026, a scenario that historically tends to weigh on risk-sensitive assets, such as cryptocurrencies, by increasing the opportunity cost of holding non-yielding digital commodities and potentially strengthening the dollar. Nevertheless, countervailing positive developments in the geopolitical sphere, including advancing peace talks between the United States and Iran, along with declining oil prices, have contributed to a somewhat improved risk appetite in broader equity markets. Although Bitcoin has notably lagged some of these rallies in Asian indices, suggesting that crypto-specific factors are dominating price discovery at present, rather than pure macro tailwinds. The interplay between these elements creates a delicate balance where any escalation in tensions or disappointing economic data releases could quickly tilt sentiment toward the downside, while favorable resolutions might provide the spark needed for a sustained advance. Higher for longer interest rate expectations tend to strengthen the US dollar, which makes dollar-denominated assets like Bitcoin more expensive for foreign buyers and can reduce liquidity in risk markets as capital flows toward higher-yielding safe havens, whereas easing geopolitical concerns lower the premium investors' demand for holding volatile assets and can encourage rotation back into growth-oriented sectors, including digital currencies. Technically speaking, the charts reveal a market in consolidation mode, with immediate support clusters forming around the $60,000 to $62,500 area, where previous tests have attracted substantial buying interest and where a breach could open the door to accelerated selling if stop-loss orders and leveraged positions are triggered in cascade fashion. On the upside, resistance is encountered in the mid to high 60,000s, with a more formidable barrier potentially around $67,000. And beyond that, the recent swing highs that would need to be surpassed convincingly on strong volume to confirm a bullish reversal and shift momentum toward targets in the $70,000 range, and ultimately the psychologically significant $100,000 milestone that many long-term holders anticipate. Some chart patterns, such as bear flags, remain active on shorter timeframes, meaning that any rebound toward the $64,000 zone could encounter selling pressure from traders who view it as an opportunity to exit rather than a launchpad for further gains. Momentum indicators such as the relative strength index on daily and weekly timeframes currently reflect neither extreme overbought nor deeply oversold conditions, leaving room for movement in either direction depending on how upcoming catalysts unfold, while longer-term moving averages continue to slope in a manner consistent with a corrective rather than outright bearish structure overall. A sustained move above $67,000 accompanied by expanding volume would likely invalidate near-term bearish patterns and open the path toward retesting the $73,000 area that marked earlier cycle highs, whereas a decisive close below $62,000 on heavy volume could accelerate liquidation cascades in the futures market and push prices toward the next major support cluster around $55,000 to $60,000. Historical precedents offer valuable context for interpreting the present situation, as Bitcoin has navigated multiple cycles of expansion and contraction, with the period following the 2024 halving bearing similarities to earlier phases, yet distinguished by the unprecedented involvement of institutional capital through regulated products and corporate balance sheets. In prior instances, drawdowns of 50% or more were commonplace during bear markets, but the current episode has been milder thus far, leading some prominent analysts to argue that the bottom may already be in place, particularly given the triple bottom-like formation observed above the $60,000 threshold and the resilient nature of the network fundamentals, including hash rate metrics that remain near record levels, indicating robust miner participation and security of the blockchain. Others, however, caution against complacency, pointing to cycle timing models and valuation metrics that in the past have signaled further downside before the next secular advance materializes, with some forecasts extending potential lows into the low 40,000s or even 30s if the bearish structure fully plays out and macroeconomic headwinds intensify. The 2022 bear market, for example, saw Bitcoin decline more than 75% from peak to trough amid aggressive monetary tightening and a broader risk-off environment, whereas the current correction has unfolded against a backdrop of already elevated institutional infrastructure that may provide greater stability than existed in previous cycles. The debate among experts encapsulates the uncertainty perfectly with bullish voices, highlighting the absorption of supply by long-term holders and the potential for renewed inflows into exchange-traded funds once sentiment stabilizes or regulatory clarity improves, while bearish perspectives emphasize the risks posed by elevated funding rates in perpetual futures markets that could precipitate violent liquidations and the possibility that current corporate buying proves insufficient to offset broader institutional redemptions in the near term. Betting markets reflect this ambivalence, with probabilities assigned to Bitcoin reaching $100,000 in the short term remaining relatively low, underscoring that participants are pricing in a period of range-bound or downward biased action before any decisive breakout occurs. This environment demands careful attention to a variety of indicators beyond simple price action, including weekly exchange-traded fund flow reports on chain exchange reserve levels, which have been trending lower in a classically bullish manner, and derivatives positioning data that can reveal when leverage is building to dangerous levels. When exchange reserves decline, it typically signals that coins are moving to self-custody, wallets reducing the immediate supply available for sale on exchanges, which can amplify upward moves when demand increases, whereas rising reserves often precede periods of increased selling pressure. Furthermore, the performance of the broader cryptocurrency market provides additional color, with Bitcoin dominance remaining a key metric to watch, as any significant decline in its share could herald the start of an altcoin season where capital rotates into other digital assets, potentially amplifying gains across the ecosystem, or conversely, if dominance rises, it might indicate a flight to safety within crypto itself during times of stress. Ethereum and other major altcoins have shown mixed responses to Bitcoin's consolidation, with some demonstrating relative strength, while others lag, highlighting the selective nature of current market participation, where narratives around artificial intelligence, decentralized physical infrastructure, and specific Layer 1 protocols are attracting attention amid the uncertainty surrounding the leader. Regulatory developments also factor into the equation, with recent moves by the Securities and Exchange Commission to scrap certain trade-through rules, potentially paving the way for greater tokenization of traditional assets, which could ultimately benefit the infrastructure underpinning Bitcoin and the wider space, even if short-term price reactions remain muted. The maturation of the regulatory environment reduces some of the existential risks that weighed on the sector in earlier years and could attract additional institutional capital over time, although near-term policy uncertainty continues to contribute to volatility. Considering the potential pathways forward, a massive breakout scenario would likely require a confluence of positive developments, such as a more dovish tilt from central bankers in response to cooling inflation data, renewed and sustained inflows into Bitcoin exchange-traded products, major announcements from corporations or even sovereign entities increasing their allocations, and perhaps favorable geopolitical resolutions that boost overall risk sentiment globally. Should these align, the technical breakout above key resistance could trigger a wave of short covering and momentum-driven buying that propels prices rapidly higher, with initial targets in the $70,000 to $80,000 zone before challenging all-time highs and beyond. Conversely, the path to another crypto crash, or at least a deeper correction, would be paved by persistent or worsening exchange-traded fund outflows, a decisive break below established support levels, accompanied by high-volume negative macroeconomic surprises, such as hotter-than-expected inflation readings or geopolitical flare-ups, and a deterioration in on-chain metrics, indicating distribution by large holders rather than accumulation. In such a case, liquidations could exacerbate the move lower, testing the $50,000 to $60,000 area, and possibly lower, depending on the severity of the catalyst and the extent of leverage positioning in the system. The presence of substantial open interest in futures and options markets means that any sharp move can become self-reinforcing, as automated liquidations and margin calls force additional selling or buying, creating feedback loops that extend beyond what fundamentals alone would justify. It is essential to recognize that these scenarios are not mutually exclusive, and the market could easily oscillate between them as new information emerges, with the current holding pattern near $64,000 serving as a battleground where buyers and sellers are testing each other's resolve. Volume profiles and order book depth will be critical to monitor in the coming sessions, as a surge in buying volume on any uptick could validate the breakout thesis, while heavy selling on dips might confirm the bearish outlook. Additionally, the psychological aspect cannot be overlooked, as media coverage and social sentiment often amplify moves in either direction once a trend gains traction, with the current relatively subdued tone potentially giving way to euphoria or despair depending on the next major price swing. Traders frequently use round number levels like $64,000 as reference points for placing orders, which can create self-fulfilling prophecies of support or resistance until a catalyst strong enough to overcome the clustered liquidity arrives. In synthesizing all these elements, the situation surrounding Bitcoin at this juncture appears finely balanced, with compelling arguments on both sides of the breakout versus crash debate and no clear consensus emerging from either technical analysis, fundamental metrics, or expert commentary. The mildness of the recent drawdown compared to history provides some comfort to optimists, while the persistence of outflows and hawkish policy signals offer ammunition to those anticipating further weakness. What remains certain is that volatility will persist and that participants must remain vigilant to evolving conditions rather than assuming any particular outcome. Factors such as the upcoming economic calendar releases central bank speeches and weekly flow data will likely dictate near-term direction more than any single indicator, and the ability of the $64,000 level to continue acting as a floor will be a key telltale sign of underlying strength or fragility in the market structure. Network security metrics, including hash rate and difficulty adjustments, continue to demonstrate underlying health even during price weakness, because miners with efficient operations remain profitable at current levels, and the protocol's automatic adjustment mechanisms ensure that security scales with participation rather than price alone. As the cryptocurrency space matures and integrates further with mainstream finance, the stakes of these price debates grow larger, affecting not only dedicated digital asset investors, but also traditional portfolios that have gained exposure through exchange-traded products and corporate strategies. The narrative of Bitcoin as digital gold, or a hedge against fiat debasement, continues to resonate particularly in an environment of geopolitical uncertainties and shifting monetary policies, yet it must contend with the realities of short-term trading dynamics and profit-taking cycles that can override longer-term theses temporarily. Observers would do well to consider position sizing and risk management principles appropriate to their individual circumstances while following developments closely as the market provides ongoing signals about which scenario is gaining the upper hand. Long-term holders often view periods of consolidation as opportunities to accumulate at relatively attractive valuations compared to cycle peaks, whereas shorter-term traders focus on the immediate battle between support and resistance levels and the flow of capital through regulated products. Ultimately, whether a massive breakout materializes or another period of decline ensues, the current consolidation around $64,000 represents a pivotal moment in Bitcoin's ongoing evolution, one that encapsulates the tension between its disruptive potential and the cyclical nature of speculative markets. By staying informed through reliable sources and maintaining a long-term perspective tempered by awareness of short-term risks, viewers can better navigate the opportunities and challenges that lie ahead in this exciting yet demanding asset class. The coming weeks and months promise to deliver greater clarity as key levels are tested and fundamental drivers assert themselves more decisively, shaping the next chapter in Bitcoin's remarkable story. Market participants are advised to watch for confirmation signals rather than attempting to predict exact turning points, because false breakouts and breakdowns are common in this asset class and can lead to significant drawdowns even for those with correct directional views if timing proves challenging. For those following along at home, we encourage you to review the latest charts and on-chain dashboards yourselves to form your own informed views, as no single analysis can capture every nuance of this multifaceted market. Crypto Hub remains committed to bringing you these detailed examinations without hype or unsubstantiated predictions, focusing instead on the data and developments that matter most for understanding where things stand and where they might be headed. The question of whether Bitcoin's hold at $64,000 signals a massive breakout or another crypto crash does not lend itself to simple answers, but rather requires ongoing monitoring of the interplay between institutional flows, network fundamentals, macroeconomic policy, and technical structure, all of which are evolving in real time and will determine the outcome in the weeks and months ahead. That brings us to the end of today's in-depth look at Bitcoin's holding pattern near $64,000 and the critical question of whether a substantial breakout or a renewed crash lies in store. We hope this professional overview has provided valuable context and food for thought as you assess your own strategies in the cryptocurrency arena. Remember that all investments carry risk and that past performance offers no assurances about future results, so always conduct your due diligence and consider consulting qualified advisors where appropriate. If you found this analysis helpful, please subscribe to Crypto Hub for regular updates on Bitcoin, Ethereum, and the wider digital asset markets, and activate notifications so you never miss an important development. Thank you for tuning in. We appreciate your support and look forward to bringing you more insightful content soon. This is Crypto Hub signing off until our next update. Stay safe and stay informed in the markets.